So I thought it would be nice to see some tips that you can use so as to make the best out of a small trading account, because I know how challenging it is and there are definitely some things that you can do so as to make your situation better. But before diving into this video, if at any point you find this video interesting or helpful, please consider subscribing to my channel and liking this video. I'd really appreciate it, and that's the best support you can give me. So the first tip that you can do when you're trading with a small account is, first of all, and that's the most important thing, and that's personally what I've been doing myself when I was having a very small account, is to trade cheap stocks. And it's a very simple thing to do. You can just build yourself a watch list of stocks that are cheap, liquid, and that's very important that they are liquid, but at least make yourself a watch list of very cheap stocks if you have a small account. So the capital requirements of each trade that you're going to make is going to be a lot smaller compared to placing a trade, for example, on Tesla or Amazon. Because think about it, when you trade with small accounts, you need to be mindful about the position size that you take on each and every single trade. And if you have a small account, let's say for example $2,000, $3,000, then you cannot afford to trade, for example, Tesla stock or Amazon or the SPY or any of those very expensive products. You need to be realistic about the fact that you won't be able to be profitable on the long term if you overexpose yourself, if you overuse your capital. That's why I said that it might be better to make a watch list of very cheap and liquid stocks that are fitting your portfolio, your small account, so at least the capital requirements of each trade are not going to be too big, and you can afford to place several trades on several cheap stocks and make yourself a portfolio of cheaper stocks. And when I started out, that's exactly what I've been doing myself. I built a watch list of, let's say, 30 stocks, and they were all liquid and they were all quite cheap, relatively cheap, because I knew that I just couldn't afford more expensive stocks. And even though it's really tempting to go trading more expensive stocks, I know how it is, it's very tempting to go for the big expensive stocks like Amazon, Tesla, Apple. However, know that when you have a small account, you really don't have a choice. Either you put more money into the account so you're able to actually trade more expensive stocks, or you go just for cheaper stocks. And I know how annoying it is to really keep yourself from going into more expensive stocks. However, when you have a small account, you really don't have a choice. And when I was having a very small account and I couldn't do much with it, I found that building a watch list of liquid and cheap stocks that were matching my criteria, my portfolio, that helped me so much, because at least I wasn't tempted to go for example, Teslas or Amazons or Apples. I was just living in my watch list and only trading this, and that helped me so much. I made a video on the subject, by the way, where I give away the watch list that I was using before, so if you want to check it out, just click in the description. I'll put the link in the description. And I want to show you the difference between two trades. One trade is for a stock that is very expensive. So let's say that for the expensive stock, we take, for example, Tesla, which is around $600 or $650. And for the cheap stock, let's say that we take Ford. If we decide to sell a put, for example, on Tesla around the 17 Delta strike, you need to put $10,000 on the table just to place that trade. And know that a very good tip to know if you want to know what capital requirements should you aim for when you're having a small account, I personally try to stick to 2% of my buying power per trade, meaning that $10,000 would need to be 2% of your buying power. So you see that if you already just need to put $10,000 on a Tesla trade, and on top of that, if you want to respect some kind of position sizing, you see that you definitely cannot afford this with a small account of, let's say, $2,000, $3,000. Now, if you decide to, for example, sell a put also on Ford, and we go around the 17 strike, the 20 strike, so a bit like what we did on Tesla, you see that now the capital requirements is only of around $200 and $250. So on the one hand, we have a trade on Tesla where the capital requirement is of $10,000, and on Ford it's only of $250, and on both you sell a naked option. And you see that it's a lot more affordable for a small account to go, for example, for a stock like Ford, because it has just less capital requirements, and at some point you need to be mindful about your position size, and you need to think about the worst case scenario. If the stock completely falls, can you handle a potential running loss in the meantime? If you have a small account and you over leverage yourself and you overexpose yourself with your capital, then you're going to be burned. Compared to if you go for cheaper stocks that are matching your portfolio size, then you'll be able to grow on the long term. And the second tip that you can use when you trade small accounts is to trade spreads. Either it's debit spreads, either it's credit spreads. It can be interesting to trade spreads when you have a small account because you can really define define your max loss and so your capital requirements. Your max loss is going to become your capital requirement, and for example, if you trade a credit spread, if you trade a debit spread, you have a lot more control and you can essentially trade quite expensive stocks with, for example, a debit spread and have also very small capital requirements. They can allow you to place a lot of trades and have very small capital requirements. However, as I say in my video, should you trade spreads on naked options, when you trade spreads, you don't have a lot of ways to defend a losing trade if the trade goes against you, compared to naked options where you have a lot more ways to defend your trades. And for example, if you want to go for debit spreads, you like to buy calls and puts in general, a debit spread is almost the same as when you buy a call or a put, but you pay much cheaper price compared to buying a call or buying a put directly. That's why a debit spread can be very interesting so as to take advantage of big moves on some stocks, because it has a very small capital requirement and you still can make some good money when you trade debit spread. And the third tip that I really found useful myself, either you want to sell options or you want to buy options, is to be on the right side of volatility, is to use volatility. And what do I mean by this? Well, if you see the implied volatility rising, it means that the option prices are getting more expensive too. And if you see the implied volatility going down, it means that option prices are getting cheaper. So if you like to buy debit spreads, because you pay a premium, you might as well go for a stock that has quite a low implied volatility, so you pay cheaper options and you have a better potential profit. And on the opposite, if you like to sell options, then you might as well try to sell very expensive options, or at least compared to what they were worth in the past, so at least you make the best trade possible and you have the best odds of profit on your side. And for that, I personally use the IV percentile. And the IV percentile counts the number of days where the implied volatility was lower than the current one, and it ranks it against the previous year. So for example, if you see that the implied volatility percentile for a stock is of 10%, it means that over the last year, only 10% of the implied volatility was higher than what it is today. So in other words, the lower the implied volatility percentile, the cheaper the option over the past year. And the higher the implied volatility percentile, the more expensive the options are compared to what happened in the past year for that stock. So if you like to buy debit spreads, for example, then you might as well go for stocks that have a very low IV percentile. And if you like to sell options, then you might as well go for stocks that have a very high IV percentile. So at least you sell very expensive options, and on the other hand, you buy very cheap options. And for that, you can use the website Market Chameleon, where you can see the IV rank and the IV percentile for some stocks, and you can basically spot some opportunities where you could use some spreads. So to sum it up, the 3 tips that you can use when you trade with a small account is to trade lower price stocks. That will have as an effect to really lower the capital requirements because the options are cheaper. Then the second tip is to use spreads. Either it's to use debit spreads, either it's credit spreads, but try to use spreads because it's a very good way of making sure that you have lower capital requirements when you place a trade. And the third tip is to use the volatility in your advantage. If you want to buy options, try to buy cheap options using the IV percentile. And if you like to sell options, maybe sell options on a stock that has a high IV percentile, so you take advantage of expensive options. All of those tips are really helpful, and that's what personally helped me when I was trading with the small account. So hopefully they're also useful for you. If you like this video, don't hesitate to like it and subscribing to my channel. As I said, it's really a great support and I'd really appreciate it. Please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.